Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Saw a bit of a decline today, a bit of a surprise, I think, after pushing north of 3% and spending a little bit of time there. We started to get real comfortable north of the 3% mark after fighting to get there for so many months and so many weeks. We got there, and then we all of a sudden started pushing 3.10 and talking about 3.25, which still I think is on the radar. It's just no longer on tomorrow's radar. It may take a little bit more time. We may have to wait until we get to June FOMC before the market makes that kind of a shift. But we made our first settle below 3% since May 11th, and I think a lot of this is now turning into more of a fear trade, more of a concern trade, more of a get me out trade, which we'll talk about later. But I think that right now, the trade is now going to revolve around, hover around 3%. We're no longer going to be talking about making a move towards 3.25, at least until we get some more data and some more clarity what's going on. Obviously, the first bit of news today was the cancellation of the North Korea summit, and that saw Treasury yields decline on a flight to quality bid. It likewise saw gold rally. So there's a lot of reasons why we traded down today. How long we stay down here may lend itself to how long that this news remains up in the air, and if we can reschedule, or if somebody writes a nice apology or something. But I think ultimately the market is reacting to that. And if you look at market volatility, it has been in decline since we peaked last week, but it started to inch up closer, especially in the shorter dated issues. And that's only because there's a lot of uncertainty now as we got a long weekend ahead of us coming up, the Memorial Day weekend in the U.S. We've got next week's jobs report. And then we've got FOMC coming in the middle of June, and that's really the main focus here. So I think ultimately volatility, while it has come off, likely should be going higher, especially when you throw in the geopolitical risks that we're seeing evidenced by the North Koreans and the U.S. not going to meet in Singapore on June 12th. So there's a lot of reasons why volatility should be higher. I think it's probably chasing what market expectations should really be, and that's why volatility is starting to go up, but I think it should be higher at this point. And lastly, let's look at the positioning. I think one of the reasons why we've seen this vast rush to higher prices and lower yields is that the speculators, they've been net short for a long time, and if you look at the TFF data, it's on the leveraged fund positioning, they've been even more short for a long time. They are starting to turn. Now when you talk about positioning shifts, you typically see it start very slowly, and then it starts to come in droves, because once you see the exit signs start flashing, you don't want to be the last one out. And I don't think this is necessarily going to be a core shift back to zero, something we haven't seen in a long time in the 10-year note. But I think that ultimately you're going to start to see a lot of these funds cover and wait and see if there are better levels to get short again. So we are starting to see the shorts, the net shorts, not only from the speculator position, but from the leverage fund community. They're starting to cover. They're probably at their levels that we haven't seen since early April, going back to March. And they've only been getting short every month since. So right now we're starting to see them cover, and that's going to have a dramatic effect on expectations going into June FOMC and later on into this year. If you're talking 3.25 to 3.5% yield in the 10-year, you have to have those shorts participate. And if you see a short cover rally, it means that it's going to delay any sort of targeting of those higher yields. So right now we see 10-year note yields back below 3%. How long, I think, really depends on the speculators. Right now they are running for the exits. This is Todd Colvin coming to you from the floor of the CME Group.